December 2020, Chrp 04 paper. Question number 5. So in that question, part 1, you are asked to explain the steps to be followed in preparing a bank reconciliation statement. The steps to be followed in preparing a bank reconciliation statement. Those steps are normally 4. Those steps are normally 4. In preparing a bank reconciliation statement, the first step you do, and that is what you always do, it is to prepare and update it. The first step is normally you prepare an updated cash book. And how do you prepare an updated cash book? You use items in bank statements but missing cash book. That is how you prepare your updated cash book. Those items that were never recorded in the cash book from the word go, and they were supposed to be there. You never recorded them in the cash book simply because you are not aware that they happened. After receiving the bank statement, you now be aware that they took place, and therefore you update your cash book to get the correct balance from that. Step number 2 is to identify and present it. To identify the unpresented checks. Unpresented checks are the checks that were paid. These are checks paid. Checks paid in cash book. But not presented. For payment in the bank or to the bank. To identify the unpresented checks, the checks that are paid. In the cash book, we have already paid them. We have captured as an amount paid. But in the bank, that payment has not been effected because those checks have not been presented by the supplier for payment to be effected. That is step number 2. Step number 3, identify uncredited checks. To identify the uncredited checks. Checks received, these are the checks received the cash book, but not yet cleared by the bank. These are the checks we received, and then we recorded them in the cash book. We receive a check, I record it in the cash book that I have received a check from Jane. I have received a check from Kevin. Then that check will be taken to the bank so that now we can receive money in our bank account. But we find that by the time the bank statement was printed, those checks have not been cleared by the bank, so the amount of money has not reflected in our bank account. They are known as uncredited. So uncredited checks are the checks that we receive, and presented checks are the checks that we pay. That is the difference. But in both cases, the unpresented and the uncredited, those amounts of money have not reflected in the bank statement. We have paid the supplier, but the deduction is done in the cash book, but money in the bank has not been deducted. Payment has not been made. We have received the money as per the cash book, but the actual amount of money has not been received in the bank. Then the step number 4 is how you prepare the for November 2021, there is a question on how to do, or a question to do with the bank reconciliation statement. We have a question. We are going to refresh ourselves there, but these are basically the steps. These are basically the steps. So you prepare the updated cash book, then you identify the unpresented, identify the uncredited, then you will come here now and prepare a bank reconciliation statement, whereby you will start with balance as per updated cash book. Balance as per the updated cash book. That is what you got, the final results of the one. You prepared an updated cash book. So at the end of the updated cash book, you will have now the correct balance for that updated cash book. That is the figure that you bring here. Then you add unpresented. What you have identified in step 2. Then you less, after adding, you get a figure there. Then from there, you less. So that now you can get balance as per bank. And that is the end of it. That is the end. No, we can have some errors here, but they are very rare. But that is actually the procedure. The updated cash book balance, you start, you add unpresented, then you minus the uncredited, you get your balance as per the bank statement. That is as far as question number 5, part 1 is concerned. Part 2, reasons why a check may be dishonored. We have got quite a number of reasons why a check might be dishonored. To be dishonored, it is just being rejected by the bank. Reason number 1, the account of the person paying does not have sufficient balance. Insufficient balance in the account of the person paying. Number 2, if the check is stale. If the check is stale, if it was written more than 6 months ago, the check, once it has been written, is supposed to be presented to the bank within 6 months. If you present it after a period of 6 months, it will be dishonored. The other thing is that if the check is not regible, if it is not regible, then their bank accountant, maybe they ask yourself, is this 6 or 8? That check will never be dishonored. That check will not be dishonored. If it is stale, we have said about that and other reasons that can make the check to be dishonored. That is it. Then we go
Walimu, just repeat that. Walimu, just repeat that.
Which part?
Why should be dishonored? Why check?
If it is dishonored, reason number 1, insufficient balance. Number 2, if the check is stale. Number 3, if the check is not regible. You have other reasons, huh? Other reasons can be if the check, the person who is paying is known actually to have died. Have received a certain amount of money from a person who is known that he had died some times ago, and it is in the public domain, that check will be dishonored. Such kind of reasons, they will make the bank not to accept that check, and they will never pay the check. Plus others, even including the spelling mistakes. If you write, maybe my account name is Wycliffe Makori, you come and then you write a different name or you misspell my name, that check might not be honored. You must write the name the way it is, because you have even different versions of Wycliffe. If you don't use my correct spelling, the check will not be honored. So question number 5B. It is about the purchases ledger control account. These are some of those questions, when you find them in the exam, they should give you marks within the shortest time possible. The control account. It is just a matter of mastering the format, a matter of just mastering the format, and actually the reasons why these entries are debited while the others are being credited. Just a minute. So it is just a matter of understanding the format. Somebody say that these are some of those low-hanging fruits that you can pick with ease. The purchases rate. Control and count. Don't forget that this one controls the suppliers who are creditors. So this is like a liability account. It controls those people to whom we are supposed to pay. Those people we owe a certain amount of money simply because we had acquired some goods on credit from them. So being a liability, increase in liability we normally credit, decrease in liability we normally debit. So what are we going to credit? The opening balance, the one that you are going to be given. In most cases, you can be given a debit opening balance and a credit opening balance. But for this, because it's a liability, liabilities they always have credit balance. This one must be provided. But for the debit balance, it might or might not be there. So if you are only given one balance, just know it is for the credit. If you are given two balances, that is the opening balances, then they will specify which amount is for the debit and which amount is for the credit. And you put those amounts as told. The debit let it to go to the debit, the credit let it to go to the credit. Then here, you are going to do what? You are going to now credit with what increases. Increase in liability we normally credit. So what will increase the liability? Credit purchases.
They are both brought down.
Yes, both of them are brought down. At the start of the year, the balances are brought down. At the start of the year, the balances are brought down. So we have here credit purchases. We also have refund from suppliers. Then we also have what we call interest from penalty by suppliers, charged by the suppliers. Those three, they will be credited in the purchases ledger control account if they are there. So what you debit, what will reduce the liability that you have to the suppliers through cash paid, checks paid, discount received, purchases returns. Remember, purchases returns is also known as the return outwards. Then purchases returns, we have the contra or the setup. The bills, allowance from suppliers. Those are the entries that reduce the supplier's balance that we owe them. They reduce the liability. You reduce the liability by paying by cash, by paying by check. When you receive discount, it reduces what you are supposed to pay. If you return some goods back to the suppliers, it reduces the amount that they were charging you. The contra or setup, we say it is a scenario whereby that supplier that you owe, the same supplier also owes you the contract. The supplier that you owe also owes you. So that amount that will cancel out as a result of that kind of a scenario. I owe you, you owe me. If it is the same amount, then nobody owes the other. If it is a different amount, the lesser amount or the lower amount will cancel out. I owe you 2,000, you owe me 1,000. I will just pay you 1,000, and that story ends there. The contract. The same supplier we owe, that supplier also owes us. So we supply the goods on credit to him, we also supply the goods to us on credit. So it is like a counter offer. Then from there now you calculate the balance carried down. This one you calculate. This for this side is the one that you are going to calculate. But if the question has given you the closing balance, the balance carried down, this one will be given in the question. You put it there. And it will balance. So this one that you calculate, it simply means that this side will have more. You add this side, you minus the total up to here. Then the figure that is making this side and this side not to agree, it is now your balance carried down that you calculate. And that is the end of it. So having said so, it is just a matter now of going to the question and find out in that question what they provide for us. They might not provide everything, but they will provide quite a number of these. So let's see. So in this question, you are given the balance brought down, the debit and the credit. And I've told you for the opening balance, you put them the way they are. So the credit, which should always be there, it is going to be more because it is a liability account, and then the debit is 12,000. So these purchases is the credit purchases, you put it on the credit. Payment to suppliers by check, that is check payment, you debit. Cash paid to suppliers, you debit. Return outwards is the same as purchases returns, you debit. Discount received, you debit. And then this balance carried down, you are given, but you will be told it is debit, but you must put it on the credit. The balance brought down, you will be told it's a debit balance, but you put it on the credit. That is the only part that you need to be very careful. It is written there debit balance, but you have it as a credit balance. So I don't know whether you want me to do that question. That is the purchases ledger. So we have the balance brought down, the balance brought down. The opening balances, they don't have any problem. You press them as you are told in the question. Press them as told as given in the question. So for the credit side, we are told it is 568,500. For the debit, it is 12,000. And those purchases are simply credit purchases. The credit purchases 2,586,500. Then you debit now the payment by check. Check paid 20,000. 1,490,000. Cash paid 20,000. That's using my format here. Return outwards. Users, it is 63,500. Then we have discount received of 13,500. Then that balance, the given balance for the purchases ledger control account comes here, and you capture it as a balance carried down because it is the balance at the end. 13,500. So this one was 105,500. Sorry, 105. This is the one that you have at 500. So if you add, you find that this side will be more. The credit will be more. This is a liability account. Liabilities, the credit is always more. So you do the total of this side minus the total of this side, so that now you can get to a balance carried down, the one that we are saying is there, and create the debt. This one has to calculate. And that story ends there. Add this side minus this total to get that figure. That's all. Very simple, very fast. Very simple and very fast. Just know that what you credit, for the purchases ledger control account, we only deal with issues to do with the suppliers. Suppliers are also your creditors. So what increases the amount that we owe them is credit. They are actually credit purchases, refund from suppliers, and interest or penalty that those suppliers have charged us because we delayed paying them. Then you debit what reduces the balance that we owe them. Like that. Giving, understand that the closing balance will change. You will be told it's a debit balance, but put it on the credit balance. Now that we are there, allow me also to explain something on the sales ledger control account. So that we can also do some addition so that you can get the difference between the two. Move along. So for the sales ledger control account, this one now controls the assets by the name debtors. Those customers with our money because of credit sales to them. So this is an asset. This is an asset account. Increase in asset in debit. So here we also start with the balance brought down. I also have a credit balance brought down. The opening balances, they are captured as brought down. Then what increases this assets balance? The debtors. What increases what the customers owes the business? The debit. Normally for credit sales. Refund to customers. That's the difference. The other one was refund from suppliers. This one is refund to customers or to debtors. It's a very big difference. Refund to customers and then interest or penalty to customers. Remember, customers sometimes or some questions we refer to them as the debtors. The other one was interest or penalty charged by suppliers. This one is the interest or penalty that we have charged our customers. We have penalized them for taking too long to pay us. It increases the amount that they owe the business. This form, you can be able to see clearly that it deals with sales, customers, and debtors. Nothing about suppliers here, customers and debtors. Then here, what reduces the customer's balance to the business is one, is cash receipt. When we receive cash from them. Two, it is checks receipt. The checks that we receive from them, we allow them. We allow them discount, they will pay as less. The contract or settle, which is normally the same amount that we record on the purchases ledger. But on the purchases ledger, it comes on this side. What else? Bills. We also have here bad debts. We can off. Those they reduce. They reduce the amount that you expect from your customers. Then the balance current down, the one that is now given in the question. The question will tell you it is a credit balance, but we normally place it on the debit balance. So that we add this, we get a total here. This is an asset. Assets, the debit balance or the debit side will always be more. Get that? Once you minus now this total on the credit, you are going to get the balance carried down. The one that now you have calculated. Then balances. After starting this figure, this totals will be the same. That's all. That's all. You need to remember. They are very easy to do because you just know the format. What am I supposed to edit is a calculator? You confirm from the question what is available, you post it here. What am I supposed to credit or what reduces the debtor's balance, you place there, it is done. Very easy to get those marks without much struggle. So question number 6, explain the following accounting concepts. Accounting concepts are also very much tested in your exams. Accounting concepts are so much tested in your exams. You'll be given 5 of them. There are not like 12 of them, but they will give you randomly 5 of them to explain what they mean. So I want to give you the list of those like 12 accounting principles and concepts. I give you a highlight of what they mean. Then we shall just revisit this question to give the answers briefly. The accounting principles and concepts. Accounting principles and concepts. Number 1, normally have the money measurement. Number 2 is the business activity. Number 3 is the going concern. Number 4 is the accounting period, also known as the financial period. Number 5 is the accrual concept. Number 6, it is what we call the matching concept. Number 7 is about the prudence. Or the conservatism. Number 8, the historical cost. Number 9, we have materiality. Number 10, have revenue generation. Number 11 is the substance of a form. 12 is the dual aspect on the double entry. The dual aspect of double entry. Those are the 10. In most cases, they give you 5 randomly. Explain the meaning of the following accounting principles and concepts. 10 marks. 10 marks. So you need to understand what they mean. Remember, these are like the guidelines on how accounting transactions should be treated in the books of accounts. How the transactions should be treated in the books of accounts. So I can give you a summary of this. For the money measurement, it simply states that only those transactions which can be expressed in monetary terms are recorded in the books of accounts. Only those transactions which can be expressed in monetary terms are recorded in the books of accounts. If a transaction cannot be expressed in monetary terms, you cannot record it in the books of accounts. You will never find it in the books of accounts. So those that cannot be expressed in monetary terms, they include things like the product quality, things like the employee motivation. All those cannot be expressed in monetary terms. You will not find them. It's about business entity. The business entity concept says that the owners of the business and the business itself are considered as two different entities. The owner and the business are considered to be two different entities. Owners' transactions cannot be mixed with business transactions. The owner's transactions, the owner's personalized transactions cannot be mixed with business transactions. If you are paying rent and you are also paying the rent for the shop, you cannot take the burden of your house rent and then you take it to the business and then you expect now the business to pay you. It should not happen. So the owners and their business are completely two different entities and their transactions should not be mixed. Their transactions should not be mixed. So we should not find the owner's personal transactions in the business records or in the books of accounts of the business. Let us not find that the school fees of the owner was paid by the business. Let us not find a case whereby there is money the owner brought to the business and it has not been captured like that. So we should not mix the two. The going concern, the business is presumed it will operate indefinitely for a very long period of time without shutting down. It will operate indefinitely into the foreseeable future. Actually, it is like it is going to continue operating like forever. The owners will change, the business will continue. The going concern, it is presumed that the business will operate indefinitely in the future, into the future. Accounting period or the financial year or financial period, this is the period, usually 12 months, in which the performance of the business is evaluated by preparing the books of accounts. It is a period, normally after 12 months, whereby we evaluate the performance of the business by preparing the final accounts. That's why you hear this is the financial year 2020-2022, financial year 2024-2025. So those periods of 12 months. After that period, we sit down, we prepare the books of accounts, we know how much profit we made, we compare with the previous years so that we can be able to find or to see the trend. The accrual, it states expenses and revenue amounts. Expenses and revenue amounts should be recorded in the financial year they occurred and not the financial year where payment was made. Expenses and revenues, they should be recorded in the financial year they occurred and not the financial year the payment was made. So we have talked about the financial year. you'll find the end of financial year 1 is the beginning of the financial year 2. If it was an expense that was supposed to be paid in year 1, but has been paid in year 2, it should be recorded in the books of accounts of year 1. That is where it occurred, not where the money is paid. If I'm supposed to pay insurance for this year, the year comes to an end, I have not paid, then I pay the next year, which is 2025. It should not be recorded in the year 2025. It was an expense for the year 2024. It should be recorded in the financial year they occurred, not the financial year where payment was made. The matching. The revenues for a particular period, should be matched or should be compared with expenses for the same period for the clear performance to be revealed. Revenues for a particular period should be matched with expenses for the same period. My volume, I think it is maximum. Expenses or revenues for a particular period should be matched with expenses for the same period so that you can get the clear picture how the business is performing. We cannot talk about the revenue that we realized for the first 4 months of the year, and then we compare with the expenses for the first 2 months. We cannot get a clear picture. For matching to take place, if we are talking about revenue we generated from January to end of April, then compare with the expenses from January to end of April so that you can get the correct picture of the performance. The prudence or conservatism, it simply states that assets and revenues, those are the positive sides. Assets and revenues should not be exaggerated. While liabilities and expenses should not be understated. We should not understate liabilities and expenses. If you understate them, you are trying to exaggerate your profit. And at the same time, assets and revenues, you should not exaggerate them. You should capture them as realistic as possible. So that if you exaggerate the assets and revenues, remember that is what the business will be striving to increase. Don't exaggerate them. The other time, you want to make sure that your expenses and liabilities are minimum. So don't understate them. Have them in the best way possible, their actual amount, without any exaggeration, so that the correct position of the business can be revealed. That is the prudence of conservatism. Historical costs, it is normally applicable on fixed assets. Those assets that are going to be in the business for a long period of time. So we have got 2 costs here. We are talking about historical costs, but because they are going to stay in the business for a long period of time, the other side is the market. The market price will keep on changing. You buy a computer today for 30,000. After 2 years, the computer is still in the business, but the same model, which is now new. If you want to acquire it in the market after those 2 years, it is now selling at that 4,000. So in the financial year 2, after those 2 years, are you going to say that you have a computer of 30,000? That is the price at which you bought it, or a computer that you have is 4,000 because that is the current selling price in the market. This principle, it guides the accountant at any given point when we are recording the value of fixed assets. We should use the historical cost, the buying price. We should use the historical cost, which is the buying price, and not the market price. We should use the historical cost. The historical cost is simply the cost you bought that asset, not the prevailing market price, which might be higher. Revenue recombination. Revenue is considered as realized.
Materiality.
Oh, materiality, sorry. Materiality. With materiality, it simply states that all those transactions which are material, all those transactions which have material effect. When we talk about that a transaction is material, a transaction that is material is a transaction that can affect the decision that you can make. If that transaction is included in the books of accounts, you will decide or make decision A. If that transaction is not included, you make decision B. So any transaction that can affect the decision that can be made by the user of that accounting information is considered to be material and it must be recorded in the books of accounts. So any information that is material, i.e., it can affect the decision to be made by the user of the information, should be or must be included in the books of accounts. And then any information that is immaterial, meaning that it does not have any impact on the decisions, it can be excluded. It should be excluded from the books of accounts so that we don't make our books of accounts just to be so voluminous, but the information there is not that relevant. So any material information must be included, while any information that is not material, it should be excluded from the books of accounts. That is materiality. Revenue realization. Revenue realization states that revenue should be considered realized. Remember, the greatest source of revenue is sales. Any business entity, it must be selling a particular product which can be goods or services. That is where we get the revenue from. That is where a bigger portion of revenue for any business comes from. So revenue should be considered realized when there is sufficient evidence that it has been earned. When there is sufficient evidence that it has been earned. So don't use promises to record revenue. Somebody just comes to your business, admires your product, and tells you, I'll come for it end month. And then you say that I've sold that item. No. You have no proof that you have earned that revenue. There is no proof that the ownership has changed from you, the seller, to the buyer. So we should only consider revenue as realized when there is sufficient evidence that the ownership of that revenue has been earned. The ownership of the item has moved from the seller to the buyer of the item. Substance of a form. It guides the accountants whether to accept some of the items to be recorded as assets or not. This is especially applicable on those assets the business will acquire through either hire purchase or through leasing. You can buy an asset by cash, you can do the leasing, you can also acquire an asset on hire purchase. On these two, the ownership is not with the person using it. If we buy by hire purchase, we use the asset, so we shall be getting what we call economic substance. We shall be getting economic benefits. Economic benefits is the substance part of it. But we don't have the legal ownership of that asset until we clear the installments. So we also have here the legal form. Here it is the economic substance versus the legal form. From the legal position, how does it say? From the benefits position from that asset, what is the position? So anytime there is a conflict between the legal position of the ownership of an asset and the economic benefits that we are deriving from that asset, anytime there is that kind of correlation, then we should go by the economic substance. We should consider the substance, the benefit, rather than the legality. So if I have acquired an asset through hire purchase, that asset is generating income in my business. Like if I bought it by cash, even if by legality it is not my asset, when I'm preparing my list of assets, I should consider it because it is giving me the benefits as if it was my asset that I bought by cash. So long story short, you can say that it is said that whenever there is a conflict between the economic substance and the legal form of an asset, the economic substance should be considered or should prevail. We should go by the economic substance. When there is a conflict between economic substance and the legal form, we should always consider the economic substance part over the legal form. Lastly, the dual aspect. The dual aspect, also known as the double entry. We know this is the life and blood of accounting. And it simply states that for every business transaction, there must be a debit entry and a corresponding credit entry. For every business transaction, there must be a debit entry and a corresponding credit entry. And that is like the foundation for accounting. That is what generates the ledger accounts. From the ledger accounts, we have the trial balance. From the trial balance comes the final accounts. So for every debit entry, there must be a corresponding credit entry, meaning that every transaction must be recorded twice. It must be recorded twice. It must be debited somewhere and it must be credited somewhere else. That is that accounting equation is not a concept, but we know what it is. I've just explained all this apart from the accounting equation itself, a concept anyway, but it is an equation that states that the accounting equation. It is an equation that states that the value of assets in the business, at any given time, the value of assets in a business at any given time should be equal to the value of capital and liabilities. Should be equal to the value of assets. Sorry, should be equal to the value of capital and liabilities. So assets must be equal to capital and what? Liabilities. Assets at any given time. Assets must be equal to capital plus what? Liabilities. This is the accounting equation. The value of assets must be equal to the sum of capital and what? Liabilities combined. The sum of capital and liabilities combined. Most cases will be given these 5 of them, so make a point of understanding them. Make a point of understanding this accounting principle and concepts. All of them, because you not know which one is told to explain.
Please repeat on money measurement.
Money measurement, only those transactions that can be expressed. Only those transactions which can be expressed in monetary terms or can be measured in monetary terms are recorded in the books of accounts. Only those transactions which can be expressed or measured in monetary terms are recorded in the books of accounts. That is the money measurement. Don't record anything that you cannot measure in monetary terms. The last question, 6B, it is about the partnership current accounts for Otis and Sam, who are operating a partnership business under the name Otis Partnership. During the year ended that 1st of December 2019, the business earned a net profit of $680,000. The partners decided to utilize the profits as follows: to pay the annual salaries to Otis and Sam, to do our own repayments, and also share the balance in the ratio of 4:5. The partnership current account. Before you prepare the current account, prepare the appropriation account. Because in the current account, you need to know how much profit did they share or how much profit did each get. That one can be derived by preparing an appropriation statement. First of all, prepare the appropriation statement unless you are given this share of profit in figure and not in ratio. So, the partners tisa. So we normally start here. That's a format. We normally start with the profit for the year. I told you what you add to the profit for the year. It is the interest on drawings. A and B. I'm just giving you a format for now, and then we do the question. Interest on drawings is an income to the partnership. You took money from the business for your own use. When you pay back, you pay with interest. That interest becomes an income to the partnership, so it is added to the net profit. Get an amount there. This amount now will be distributed as follows. One, you normally pay less interest on capital. Part of it will go to the interest on capital. That's that. Part of it is going to be to go to the salaries. What A will get, what B will get. So after doing that, and there, part of it is going to be used to pay the loan repayment to partners. So before they share profit, we pay interest on capital if the partnership agreement allows that. We pay the salaries to the active partners, and then we do any loan repayment to the partner. Even these salaries to partners, not to the employees. This is to the partners. So that now we can get an amount to be shared. We'll get now the amount they will share. Amount to be shared in the profit and loss sharing ratio, this figure. Once you have that amount now, you less the profit share. You less the profit share. What partner A will get as per the ratio, B will get as per the ratio. And once they have shared that, they get the balance. They will share everything. Partnership who don't have retained earnings, they normally share, and then near balance is going to be registered. So it is a matter of understanding the appropriation. The next day, they will not ask you to do maybe the partner's current account. They will ask you to do the appropriation account. Appropriation account, that is the format. We add the interest on drawings to the net profit so that we can get that. And then that amount now, we pay the interest on capital, salaries to the partners, and if there is any loan repayment to the partners, we pay, and then there is an amount now that remains to the share. If it is a loss, they will share that loss. And then the share of profit or loss, then nothing remains. Then nothing remains. For this question now at hand, if we go to the question at hand, you just work with what it is, what you are given. We are only given annual salaries, loan repayment, and share the balance. So we are not given about interest on drawings. We are not given about the interest on capital. All those are not provided. If they are not provided, you just omit those sections. Omit those sections. So the profit for the year was how much? The profit for the year. So this interest on drawings was not there. Profit for the year was 680,000. Then because we don't have interest on drawings, that is the only thing that we had there, we shall now rest. Salary. This person by the name of Otis is entitled to a salary of 150,000. Sam, a salary of 240,000. That is a total of 360,000. We shall rest. We also less the loan repayment. Otis and Sam. The recording is on, don't worry. The loan repayment, 100,000 for Otis. The other person is 40,000. So that is a total of 140,000. Then now, whatever remains after paying the salaries and the loan to the partners, that is what is to be shared. That is the amount to be shared. It's 80,000 minus 360,000 minus 140,000. You get 180,000. That is what is left for them now to share in their profit and loss sharing ratio, which we are told the profit and loss sharing ratio is a ratio of 4:5. So that's now the share of profit. For Otis, you will get 4 out of the sum of the ratio. 4:5, you add 4 plus 5 is 9. So this one will get 4/9 times 180,000. For Sam, the ratio for Sam is 5. It is 4:5. Right? 4 is 4, Otis, that is why it's getting 4/9. Sam, the ratio is 5, so it is 5/9 times 180,000. So how much will each get? How much will each get? For Otis, get 144,000. For Sam, 36,000. Sorry. Sorry. It is 50,000. This one will be 100,000. Add the two, they give you 180,000. 180 minus 180, you get 80. That is the appropriation. You need to start with appropriation so that now you can get this share of profit. So you cannot get it any other way. You need to do this for the purpose of getting this, because this was part of the current account balance. If you go to the question was asking about what? The question was asking about prepare the partner's current account. So whatever we have prepared is the appropriation, but the question was requiring the current account. So they knew you must go through the process of preparing the appropriation before you proceed to the current account for you to earn the 10 marks. So that is the Otis and Sam. O is for Otis, S is for Sam. The debit side, the credit side. Want to remind you, how do you prepare the current account? What the partners will be receiving from the business or from the partnership, we credit. What they will be receiving from the partnership, we credit. In this case, they will receive a salary, 20,000 for this, 40,000 to some. Credit, because that is a benefit to them. Number two, it is about loan repayment. Loan repayment. For Ortiz, 100,000. For the other one, 40,000. Loan repayment. That is another thing that they are receiving. Anything that they are getting from the partnership. Then there is the profit share. 8,000 for Ortiz, 100,000 for Sam. Anything as per the appropriation. I'm just lifting these figures from the appropriation. The salaries, what each will get, I credit to them respectively. The loan repayment, what the business will pay them, credit to them. Even this profit, they are sharing the profit, so they are gaining from the partnership. And then what we normally debit, which this question does not have, it is actually the drawings. Remember drawings, the partners took money from the business for personal use, or took some resources, not necessarily cash, took some resources from the business for their own personal use. So drawings, it is an amount or anything the partners are supposed to return back to the partnership, to pay back to the business, we normally debit. And it's actually interest on the drawings. The drawings amount themselves, and if it was share of loss, if they were sharing a loss, it could have come here. But if it is a share of profit, it is a gain. If it is a loss, it is the partners to bring back to the business an amount equivalent to the share of their losses. But in this question, we did not have anything. In this question, we did not have anything to be debited. No drawings, no interest on drawings, no loss. So we don't debit anything, so we just balance. For this one, it is going to be 300,000. So the balance carried down for this is 300,000. Then here is 300,000. That is done. This one is going to be 380,000. So the balance carried down here is 380,000. The total here is 380,000. That is how you earn your 10 marks. Current account, credit what the partners are benefiting or gaining from the partnership. Then you debit what the partners are supposed to return or to refund the business. That is all. That is all. That is all that paper. So good. Good to go. Let us see the question on November 2021 paper. So this paper, question one, which is always compulsory,
Can I ask a question, please? The appropriation account we've done is for profit. Can you be asked to do the appropriation account for losses?
Yes. Yes. If the figure that you will get after paying the interest on capital, after paying the loan repayment and maybe the salaries, if you get a negative figure, then they will share that negative. That will be share of losses. They will share those losses. They need to fund the business that money. It is just a matter of who sets the question and what is testing. You might want to test whether you know how to appropriate the losses, but it is the same. If it was a loss of 200,000, that would be negative 200. You just distribute that loss as per the ratio that you are given. That's all. Okay. So question number 1A was about ledgers. What about ledgers? About the transactions from the books of Chrp Enterprises for the month of March 2020. March 1 started the business with 100,000 in cash, 900,000 in business bank account. Money to start the business, never forget, it is capital. Capital is always credited the business when the business is starting. Mark that, bought furniture. We say the furniture is not stock, so you don't record it in purchases. We shall debit when you buy anything. When you buy anything in the business, you debit that item that you have bought. But for goods, we debit them in purchases. But other things which are not goods or stock, when you buy them, you debit that item that you have bought by its name. So if you buy furniture, you debit furniture. Furniture limited on the other side will be a liability you credit. We shall do it on the board, don't worry. Paid 150,000 for rent. We have always said that anytime an expense is paid, you debit that expense. So here we shall debit rent and credit what? Bank, because we paid by check. Both goods, I've just said, anytime you buy goods, you debit purchases. Then you credit. If they were bought by cash, you credit cash. If they were bought by check, you credit bank. If they were bought on credit, you credit the supply. But purchases will always be debited when goods are bought. You debit them. If it is cash, you credit cash. If they were bought by check, you credit bank. If they were bought on credit, you credit the supplier, who becomes a liability to the business. When you sell goods, you credit sales. Always credit sales when goods are sold. Then you debit who? If they are sold by cash, you debit cash. If they are sold and money is received by check, debit bank. If they are sold on credit, you debit the customer. I hope you can understand now. That's clear. The difference between buying and selling of goods. When goods are bought, debit purchases. Where will you credit? Either cash or bank or the supplier. Because cash will be spent, you credit. If you pay by check, check or bank balance will be reducing, credit bank. If it is on credit, we have created a liability. Anytime you create a liability, you credit that liability that will owe the business. When goods are sold, sales will always be credited. Where will the debit go? Either to cash if they are sold by cash, to bank if check was received, then you debit the customer if it is on credit. So we shall debit to Amba and then credit sales. Purchased goods worth 50,000 from Banita traders on credit. I've just said that. Debit purchases, if it is on credit, you credit Banita, who is the supplier. Goods worth 5,000 were returned by Wamba. Those are known as sales returns. You debit the sales returns. Sales returns is always debited. If you debit the sales return, then you credit the customer returning the goods, who is Wamba. Borrowed 800,000 from Chrp Bank. Chrp Bank becomes a liability to us. We credit Chrp Bank, we debit the bank because we have received 800,000. Chrp Bank is a liability. Anytime you get something on credit, the person from whom that item has been received, you credit. Then you debit what has been received. We have received 800,000 in the bank, so we debit the bank. We withdrew 200,000 from the bank for office use. That is money taken to the cash box or to the petty cash. Debit cash, credit bank. And that will be the end of the story. So how do we do it practically? So the first transaction affects capital. It affects three accounts: capital, cash, and bank. Capital is always credited when business is starting. So you come here and say, this is 1st of March. Part of this capital is in the bank. Part of this capital is in cash. The amount that is in the bank is 900,000, which then you need to debit your bank with that amount. Credit capital, debit bank, because that is money deposited by the owner of the business in the business bank account. So bank is receiving. Anytime bank is receiving money, debit to the bank. Credit capital. For cash, it is 100,000. So the business has deposited 100,000 in the cash box. Cash is going to be debited by capital. That is how transaction 1 will be recorded. And that is the end of it. Old furniture, whenever you buy something, if it is not stock, you debit that item you have sold. Open the furniture account. This one has been acquired on credit, so there is a liability. Furniture limited. Debit what you have acquired. An asset has been received by the name furniture. 3rd of March from furniture. Know the names interchange. When you are recording in furniture, you use the name of the other account. 300,000. Then furniture is a liability to credit now. That is the double entry, the dual aspect. Debit, credit. The next date, it is on date 8th. On 8th, paid rent. You have rent accounts. How did we pay this rent? This rent has been paid by check. All the expenses are normally debited when they are paid. So you come here and say, 8th of March, paid through the bank, 150,000. So that simply tells you we have spent the cash in the bank. The bank balance is reducing. This is an asset. When an asset is reducing, you credit. You pay rent. Expenses are debited. Then you credit either cash or bank, depending on which account was used to pay that expense. Cash outflow or bank money outflow, you credit the cash or the bank respectively. March 11, bought goods. If their goods, don't think twice about it. Open the purchases account. Or stock or goods bought, they are debited here. How are these goods bought? They were bought by cash. How much? 80,000. What does that tell you about cash? Cash is reducing. It is an outflow to finance the purchases. Outflow you credit. You write here it has been used for purchases 30,000. 30,000. Debit and credit has been done, double entry. On 17th, sold goods. When it is goods sold, they are recorded in sales account. Always credited. Always credited. So what do? You credit. They were sold on credit to Wamba. So the other account will be Wamba, who is a debtor. So this is 17th of March. The other account will be in Wamba. 30,000. So open that account for that customer. Debtor by the name Wamba. This is an asset. A customer with your money is an asset to the business or to you. This is 17th of March. Sales. Have our money as a result of credit, sales. That is sorted. On 18th, we purchase goods. When you buy goods, regardless of the mode of buying them, purchases will be debited. Regardless of the mode of buying them, purchases will be debited. So debit, this is on 18th of March. We bought them on credit from Banita. So you write the name of the supplier there. How much were these goods? 350,000. So we owe Banita. Banita is a liability to us. We credit you. Why is he a liability to us? Because on 18th of March, we did what we call credit purchases from him. And the liabilities will be 50,000. Liabilities will credit them. Liabilities will credit them. But then, anybody who you owe, when you create that debt, you credit that person or that institution if it is a business. Goods worth 5,000 were returned by Wamba. Remember Wamba, we had sold the goods to him. Go to the account of Wamba, it shows that there is sales of 30,000 that was made to him. So when he returns those goods, first of all, this debtors amount that you are expecting to receive from Wamba will reduce by the 5,000 of goods being returned. So on that date, this is reduced. Decrease in asset credit. You come here and you say, this is on 22nd of March. The balance we expect from Wamba is reducing as a result of what? Sales returns of how much? 5,000. We have subtracted 5,000 from 30,000. So when we shall be getting the balance, it will be 5,000. Then you will debit an account called sales returns, which is always debited, always debited when customers return goods. When customers return goods, we debit those goods that have been returned here, and we credit the customer who is returned. So on 22nd of March, we have received some goods as sales returns from Wamba of 5,000. If another one returns, we record it here. If another one records, we continue with the risk. That is how we deal with it. When the customer returns the goods, debit sales returns, credit the customer return. Then on 24th, borrowed 800,000 from Chrp Bank. So we need to have an account for that. Let me press it here. Chrp Bank, we shall have a liability to them. Remember, you cannot create credit or liability without receiving something. You create a liability by receiving something, which is an asset. So you credit that liability, which is on 24th of March. We received this one, not indicated, but it is going to be the bank. The bank will receive 800,000 loan. Liability with credit. But we have received cash in our bank account. In our bank account, there is money that we have received from Chrp Bank. But if it is for a liability, maybe you received here Chrp Bank. That's all. Anything that you borrow or is received on credit, the institution or the person from whom we have borrowed or bought on credit, we credit, and then we debit that item that we have received. We have received the cash in the bank, so we shall debit the bank. Lastly, we withdrew 200,000 from bank for office use. For office use, it is not the same as drawings. Office use, it is simply money transferred from bank cash. From bank to cash. So in the bank, we have done a withdrawal, which is a money out. This is 28. Money is going to cash. This is money out. We minus 200,000. Anytime you are withdrawing money from the bank or you are paying through the bank, credit, then it is going to be received the cash. And the money is from bank. 100,000. And you are done with posting. You are done with posting. You are done with posting. What remains is for you to balance these reasons. But if time is not,
But you is 200,000, not 20,000.
it is.
The bank,
It is how much?
200,000.
That is what I've written here.
Yeah, and here
And
at the cash.
I've received 200. Not
Yeah.
cash has received 200,000. Bank
Yeah.
has given 200,000. Then you balance them. I will just balance 2 or 3 accounts and then I move on. So for capital, you just identify the side with less. Remember, a reg account has got debit and credit. Between the debit and the credit, which one is having less and by how much? That side with less, we make it equal with the side with more by inserting a balance carried down. By inserting a balance carried down on the side with less. And this balance carried down carries the date of the last day of the month. So like here, this is 1 million on the credit, 900,000 plus 100,000. But on the debit, there is nothing. So this one is missing 1 million. 1 million. And that is what you write here. The last transaction was 28 as balance carried down. Insert that figure. For these two sides to be equal, we are lacking 1 million here, so that both sides can be at 1. But remember, the carried down, it was just placed there for balancing purpose. That balance, like for capital, it is going to be a credit balance. Because it is the credit that had more. The balance would always belong to the side that had more than the other. So the credit had 1 million more than the debit. So because it is the credit with more, when we start the next month, 1st of April, it's going to be a balance brought down on that side that had more. Remember that. Like here we have a total of 300,000. Here we have got 30,000. So this side is less. Less by how much? It is less by 270,000. So that 270,000 is the balance carried down. It has been placed there to make the two sides balance. It is here for just balancing, but it is not a credit balance. It has actually been brought from the debit. It is the debit with more. So by pressing to 70,000, both sides will have 300,000, and the account has balance. But this to 70,000, it is a balance of the debit. 30 of the new month as balance brought down to 70. The carried down is the same amount, but it brings down. For the bank, how
Mwalimu, a
much is on
question.
the debit?
Mwalimu,
1,000,000.
excuse me.
Yes.
On the cash account, I don't know whether it's me who did not follow well. On
Yes.
the 11th of March, the purchases, are they of 80 or 30?
Oh, it was 8. It is 8. You are right. It was 8. Because I can be able to see it here. 8. 8, meaning that 300,000 minus 8 is 20. So the balance will be 220. Thank you. Yeah, you are right. The balance will be 220 to make it to 300,000. For the bank, this is 1.7. So this side is roughly what? This is just 350. How much do we need to add here so that we can total 1.7? That is going to be your balance carried down. 1,350,000 is missing. Make it 1,700,000. The carried down is carried from the debit side. That is where we shall have the balance put down. 1,350,000. And the story continues. So you can finish the others. And then find the side with less. That is where you press the carried down. And then now the brought down will go to the other side that had more below the total lines. After drawing the two lines, you record the brought down there. This one we have done it. It's about the sales ledger control account, but I can remind you, the balances brought down, you capture them the way they are. The debit ready to go to the debit, the credit ready to go to the credit. And then we say on the debit side of the sales ledger, because it's an asset, we record the credit sales, dishonored checks, and then what? We have refund to customers. We don't have interest or penalty. We don't have interest or penalty. But do it very fast so that you can emphasize. From the format that we drew when we were doing that formatting, sales ledger control account. So this is the day up. Always label your accounts. The debit and the credit sides should be well labeled. So the balance goes down. The opening balance we say should be captured as goes down. 178,000 on the debit. The balance goes down on the credit. It is 17,000. Those are just marks that you have received or you have earned by just doing that. Then we said we have got the big 4 items that will be on the debit. That is credit sales, dishonored check, interest or penalty to customers, and the refund to customers. Identify out of those four, what has the question provided you? Have the sales, 672,000. Have the dishonored checks, of 5,000. We also have a refund to customers.
Mwalimu, which question is that? Sorry, I didn't get it.
Sorry?
Which question is that? I didn't get it, sorry.
We are going procedurally. We had done question 1. We are now at question B.
Okay, okay.
We are going procedurally. Okay. Refund to customers, it is 7,000. Those will be debited. Then the others now will be credited. We said we normally credit what? The checks received. The checks received amounted to 380,000. Discount to customer, that is simply the discount allowed. Discount to customers is the discount allowed, 35,000. Then we also have goods returned by customers. Those are sales returns or return inwards, 18,000. Then we have bad debt written off. Bad debt written off, 9,000. This one being an asset, the debit will be more, so the balance carried down will be there. We are not given the closing balance, so we are not given the closing balance or the balance carried down given. So we only compute that. And this minus this totals, you get that figure, and your account will balance. That will be your sales ledger control account. That will be your sales ledger control account.
Mwalimu, I have a question.
Yes.
The refund to customers, is it a credit or a debit?
For the sales ledger, refund to customers is debit. For the purchase
sales ledger.
refund from suppliers is credit. That's all.
Okay, fine. Thank you.
Refund to customers for the sales ledger is debited. Refund from suppliers for the purchases ledger is credit.
I'm not yet clear, Mwalimu, on that issue of refund to customers.
You have not
I've not yet understood.
You have not grasped why.
Yes, refund to customers and the other one that you have mentioned.
Refund. Yes, that is now. This class now it is a normal one. Farida, when you go to the exam, make sure you carry the ruler, you carry the calculator, and a blue and black pen. Your work needs to be neat. Accountants are very neat. And then you draw very good ledger accounts using your ruler. Okay, let me go now back to the issue of refund. For the refund, many will think that it is going to be an entry on the credit, but we don't debit that. The reason being, when we talk about the control accounts, we are talking about one account controlling so many debtors. Remember, this one account is controlling all the debtors. Not one single debtor. All the debtors are controlled by that one account. Instead of having like 10 different ledger accounts for every specific debtor, we consolidate them in one account. It becomes the control account. So the reason as to why it is going to be considered as an increase in the debtor's balance is this. can give you a practical example. All your debtors combined, they were to pay you 100,000. I want to bring out why the refund now becomes an increase instead of a decrease. All of them are supposed to pay you 100,000. Then you receive from one of the debtors, you receive, for example, 30,000. That simply means that the balance is now 70,000 from the others. The others are supposed to pay you 70,000, so that if you add with this 30,000, you can be able to recover your 100,000 back. Now, this is the case. What will happen if this person who has paid you 30,000 had overpaid you by maybe 5,000? Maybe there is a discount that you had allowed him. He forgot to deduct that discount. He just paid the full amount without deducting the discount of 5,000. And later he discovers that he will ask for refund. When that refund is going to be made, it simply means that, remember, you must receive your 100,000. When you are getting this balance of 100,000 from all of them, you had factored even those discounts. You had deducted them. So you need to get your 100,000. If this person gave you 30,000 and later he realizes that he had overpaid you and you make a refund, then it simply means after doing a refund of 5,000, that simply means the person has paid you what? 25,000. If he has paid you 25,000, now the balance will not be 70. The balance will be 75,000. So when you receive money, before you do a refund, you normally reduce your debtor's balance. But the moment a debtor asks for a refund because of overpayment, you refund that money to the debtor, but that money that you have refunded, you add to the balance. You add to the balance. Initially, he had paid 30,000, the balance became 70,000. Once you refund the 5,000, it simply means that 5,000, there is somebody who is supposed to pay you that money. So you add it to the balance. And that's why we say anything that increases the debtor's balance, you. So we are debiting because we have refunded, and that refund has been increased to those who have not paid. Are you getting my point now?
Yes.
Halima, I was also wondering why, but now I think I've gotten it, because this is like we are refunding his money going out. Why are we debiting? But now I've gotten it.
Yes, we are refunding the money, and I've given you a right example. If you are 10 debtors, all of them combined are owing you 50,000. This is what the 10 debtors owe you. One of them pays 10,000. After paying you 10,000, so the balance is 40. But this person who pays you 10,000 tells you that he had overpaid by 2,000. You refund the 2,000, then the balance now will increase from 40 to 42. That money that you had deducted, it is somebody who is supposed to pay you. Yeah? So that person has not paid you, so that you can be able to receive your total amount back as per the books of accounts. That's all. So the balance of the refund increases the remaining balance, even from the supplier's point of view. Once the supplier has refunded you, it simply means that there is another supplier that you have not paid, so that you can be able to clear all your suppliers. I think now you know. Now you know. So I'll just go to question number 2A, and then we stop there. Question 2A, and we can do the others in our subsequent classes. So for 2A, it is talking about what? It is talking about the 5 characteristics of a valid accounting information. This is like the same as the attributes or characteristics of a good accounting information. Characteristics of a good accounting information. We say the good accounting information should be timely, timeliness. A good accounting information should be relevant, relevance. A good accounting information should be reliable or reliability. Good accounting information should be complete. Completeness. A good accounting information should have consistency. Should be prepared in the same way. Their treatment of the transaction should be in the same way. And then we also have comparability. A good accounting information should assist the users in making comparison between the business and its competitors, between the business itself, that is the current year, versus the previous year. These are the characteristics. And they are also part of the accounting principles. These ones, they are also part of the accounting principles. And what concepts? So don't worry, when you find that, you are told explain the meaning of the following accounting principles. They tell you going concern, materiality, and then they tell you consistency. It is part of them. They are part of also the accounting principles and concepts, and they are also characteristics of a good accounting information. They serve both. They serve both. So with that, I think we can stop there. We can stop there. How to pass accounting? Every format should be of the correct format. Every account have it in the correct format. Ready accounts, we know how they are prepared. If it is a reconciliation account, know how it is prepared. Control account, so don't go and mix things. So we'll pick from there next time. You remind me we have stopped question what? We have done question 2B, 1B, 2A. So we should probably start now from question 2B. These are now those questions that they will always be in your exams. The income statement, statement of financial position. There's a question here, is cash book, bank reconciliation. So by the time we finish like 2 or 3 papers, you'll find that we have revised the entire syllabus. So with that,
When are we meeting?
Sorry?
When are we meeting next?
Same day, same time. Monday.
Monday 6th. So Thursday we are not having a class.
Thursday. Are you in the new curriculum?
Yes. So we always have classes on Thursday morning. So are we still having?
Okay, let me now clarify. I have now understood.